Hello and welcome to the Stansberry Investor Hour. I'm Dan Ferris. I'm the editor of Extreme Value and the Ferris Report, both published by Stansberry Research.
And I'm Corey McLaughlin, editor of the Stansberry Daily Digest. Today we interview Jared Dillian, author and editor of the Daily Dirt Nap newsletter.
And Corey and I will give you a little sneak peek of our 10 surprises for 2024.
And remember, if you want to ask us a question or tell us what's on your mind, email us at feedback@investorhour.com.
That and more right now on the Stansberry Investor Hour. "2024 is right around the corner. Thanksgiving is behind us. It's coming. It'll be here."
Looking forward to it. Let's go. Still got some leftovers
Yeah.
in the fridge from Thanksgiving, though. But yes, let's move on to 2024.
Yeah, we got good leftovers, and looking forward, of course, at the end of each year now, we do our 10 surprises, 10 things that would surprise investors in the coming year. And the one that I want to sneak preview, I would hope it would be kind of obvious. I really would. And I think it would surprise a lot of people if let's call them the Magnificent Seven, the 7 stocks that have led the market higher and higher all year, um, if they underperformed horribly, if they, how does one say, sucked wind? If they were, we're talking Apple, Microsoft, Amazon, Meta, Nvidia. I always leave one out, but you know which ones I mean.
Right.
Those 7. Tesla is another one.
Google.
Yeah, Google, Alphabet.
Alphabet.
That's right.
Yep.
So if those 7 stocks did not absolutely scream again, or if they didn't do well, if they didn't go up, if they just didn't go up, I think it would surprise a lot of folks.
Yeah, you do. Yeah, so you do think that will surprise people because I guess maybe I'm I'm looking at it like they've gone up so much that they can't possibly go up. Am I wrong in that thinking? That's not the mainstream thinking, is what you're saying. Yeah.
Yeah, I don't think it is. I think everyone believes, I think lots of people, I won't say everyone, lots of people believe we're in a new bull market.
Okay.
And they think those 7 stocks are unassailable. They're, you know, I think the performance, to me, the performance speaks for itself. The performance tells me that lots of people love them. And the problem I have with them is that at this point, they're viewed as absolute no-brainer great performers.
Right.
They're safe. I mean, they're trading at an average of like 55 times earnings. They're not safe. They're Cisco in March of 2000 at this moment, okay? They're not safe. And I mean, at least they're not priced for any kind of return in the near term. So
Yeah. No, I am
Yeah.
with you. If anybody's thinking though the Magnificent Seven are safe in 2024, I would caution against that. It's certainly not what I'm thinking. We've already had this run up from them in this year, so
Yeah.
and if we think what's going to play out the next 12 months, or even if it doesn't, like you said, they're priced for, I guess more than perfection, right? 50, it's, can you go up from there? I don't know. So,
Yeah, can you go up from perfection? I don't know.
yeah.
So yeah, I just I think that more broadly, I think, if the market isn't up next year, if we're not in a new bull market, I think that might surprise a lot of folks. People think, the dip has been bought and it's clear sailing from here. I don't know.
Yeah, I'm not so sure. I'm not so sure about that one. This is getting me excited about thinking about the surprises that we said this time last year. Trying to think of them off the top of my head, excuse me. Yeah. I remember one of them I'll just mention was
Sure.
Bitcoin making a new all-time high this year. I said would surprise a lot of people if that happened. And now, obviously that hasn't happened yet.
Right.
However, I will say that Bitcoin has been up over 100% the last year.
Absolutely.
And it's about a double in the last couple months alone. So my point there with that surprise last year was that Bitcoin was hated so much at the time. You had SBF, you had the FTX thing, you had just plunged from all-time highs to to where sentiment, which our guest Jared Dillian will talk about a little bit,
Yeah.
was so low. I didn't think it could go any lower. So, I figured if you want to take a hold, if you're hodling your Bitcoin, you would still want to hodl it. That would not be the time to sell. So that would be, you would just want to hold on to it. And
Right.
if you did that, you've made back some from the all time highs. You're about like halfway there to 60. You're at
Yeah.
37,000 now, up from 17, I think it was, and
Mhm.
so yeah, surprises can happen. Now it's not a new time
I
all time high, so I'm not going to take credit for it, but it was
Thank you.
trending in the right direction there.
Yeah, so I just wanna beat this one horse to death, a little bit more. So of the Magnificent 7, do you know which one is the worst performer?
Uh, I don't. I want to say Alphabet, but I
Um
could be wrong.
you're actually not far off. Alphabet year to date as we speak is up 55.7%. The worst performer is Apple, up 46%. The worst performer, the worst one,
Wow.
is up 46%. Of course, Nvidia is the best, up 227% just since January the 1st. And Meta is up 181%, which we should probably give our colleague Whitney Tilson just a little shout out. He was really bullish on them a little over a year ago, and really nailed that one. But wow, Tesla up 91%, Google up 55, Amazon up 74, Microsoft up 57. Um, wow. You know, I mean,
Yeah.
those numbers, for a 1 year, an 11-month, actually, not even a 1 year, an 11-month performance, those numbers are amazing. These are like $100 billion market cap companies. I'm I'm just sitting here going, and $1 trillion. What am I, there's a few $1 trillion market caps in there.
And what is it? It's all, is it all AI optimism? Is that what we're talking about here? Is that what the market's doing? I don't know. I mean, it's just
That's not a bad guess, I think.
I mean, if that's the case, then it would make sense that, maybe you're pricing in 10 years of, future returns there now because if they're
It
just
looks like it, yeah.
betting on the AI story or, nobody knows what's gonna happen with it exactly except it's coming. So, um, I don't know. This also reminds me, if you're talking about those returns, what about the rest of the market? Like, what has the rest of the market been doing? It's not much. If we've talked about those equal weight measures and indexes before. It's
Right.
just it just also just reminds you of the unmagnificent 493 that are just plodding along.
Yeah.
And maybe there's some good buy opportunities in there
Well,
eventually. But
sure. The Unmagnificent, you're talking about the rest of the S&P 500, of course,
right.
and the S&P 500 equal weight is up 3.7%, right? So Apple is up like 46, biggest stock in the index, Microsoft, Amazon, all these are in there. And the whole equal weight is up just less than 4%, but the Russell 2000 equal weight minus 5% here 11 months into a screaming hot year. I just
A lot of divergences, they would say in technical
yes,
speak. Divergences, which
alligator jaws, yeah,
yeah, which say all is not well, or all is not. It's
right.
not a screaming bull market. It's obviously been one for those tech stocks, but
Yeah,
for everything else, not so much.
yeah, screaming bull market for like $7 trillion market cap tech stocks. I think Tesla is the only one that doesn't have a $1 trillion market cap, and still a bear market, down 30 odd percent from the highs of late November 2021 for everything else. For everything else. I mean, it's just,
So
I
is
don't
this good
know.
news or bad
And
news for the overall market? That
well,
there's the Magnificent Seven and there's everything else that's been flat
yeah.
essentially. I don't know.
Well, it's, looking backwards, of course, it's not great news, is it? But looking forward, I'm sure everyone would tell you, oh, but the breadth, it has recovered and it's, gone from like 10% of the S&P 500 making new highs or whatever to something like 70%. Those kind of numbers. I don't know the exact figures, but I did see from 10 to 70 something recently. We've all heard breadth a million times in the past month, right? Breadth, oh, breadth. And maybe this is it. Maybe that's what happens. You get a breadth recovery and then you really are in a new bull market. I'm skeptical because I think everything's still expensive as hell.
Yeah, I mean, and I'm skeptical just because I think a recession has essentially already begun. I think, and
Oh, yeah.
you may disagree or agree. I don't know, but I I'm skeptical for that reason. If you got these expensive stocks
Mhm.
at 50 times earnings, and we're saying well, they can't possibly go higher, could they? I mean, I guess they could, but at that point, I'd be even more skeptical. So it's
Right.
uh,
It can always get worse.
yeah, yeah. So yeah, just be careful if you're piling in those ones at this point. I mean, I think there's a lot of different other ideas that are worth considering
Mhm.
than chasing Nvidia and Meta and everybody higher.
Yep. So
Don't be Cisco in 2000.
exactly.
Yeah.
Yeah, don't that's right. Don't think that the stock that has just screamed and is trading for 200 times earnings is the no-brainer that you have to own. That's what Cisco everybody, is in 10 of the top 10 mutual funds of its time, and it still hasn't recovered 23 years later.
Uh,
So, alright. I feel like I bring up the same statistics over and over again. I'm like an old guy that keeps telling that same story at dinner. "Yeah, I remember Cisco.
uh,
Cisco, 200 times earnings." Why do I do this, I guess?
somebody at Thanksgiving was telling me the same thing. I remember when Cisco was, the toast of the town.
Yeah, exactly. In my day, we had Cisco, and everybody thought it was a great thing. So, but there's a reason, of course, why I repeat this stuff. It's because I think it's still relevant. I'm gonna keep talking about how expensive everything is, and how I expect the stock market to, at best, go sideways for the next several years, or actually, I think sideways for several years and down for a few makes the most sense to me, and I think probably next year I shouldn't say this, but one of the bigger one of the other surprises will be, that the economy will do better than people think, interest rates will stay high, valuation will start to recover, which means stocks will fall, and credit, I think, will be a better investment. I think there will be problems in credit markets, and there will be defaults and things, but, the credit investors will have a field day. And I think that field day, buying bargains is a couple years off for equity investors.
Yeah, it sure seems like that. I mean, to me, when I'm hearing we reiterate the valuations of the tech stocks, interest rates staying probably higher. I don't think they're going to be go as low as maybe some other people think. So you're looking at that and you're like, the 60-40 portfolio still is not I don't think is a solution right now. And, especially if bonds don't recover to those levels that they were, in the last 10 years, which I don't, they shouldn't if rates stay higher. Um,
Right.
or they won't if rates stay higher. And stocks just risky at this point. It's
Yeah,
wise to look at some other things, like
I
commodities,
agree.
especially if the Fed even cuts rates a little bit. I think that's going to reignite the inflation story or reality,
Oh, yeah.
and
Yep.
we'll be talking about inflation, high inflation, and commodity prices all over again. Which
Yeah.
it may be that may happen. Like that may be natural and healthy for this to happen. Like in a rate hiking cycle, higher rate environment. Like this is going to be the new story. Like when
Mhm.
the Fed cuts rates, oh, let's not juice the economy too much. Let's try to keep inflation under control instead of we need inflation over 2%. Let's not forget that the Fed was begging, trying to come up with anything to create inflation for like 15 years, and now they're trying to do anything to get rid of it. It's like, all right,
Yeah.
so that part of the story is flipped on its head. So anyway, think of some about some other things if we're besides the old 60-40 conventional stuff that has worked for the last 40 years. Four,
Right.
40 out of the last 42, the last two
Yeah.
not included. Yeah.
Yeah, that's right. 40 of the last 42. Yeah, I don't disagree with any of that, and that's what I've been doing in the Ferris report. I mean, in extreme value, we find, like, the greatest businesses, the most cash gushing, wonderful businesses. We have not recommended any of the Magnificent Seven, even though, you know, 5 or 6 of them at any given moment are the most incredible businesses that have ever existed, but they're just priced for more than perfection, as we said. But aside from doing that in extreme value, in the Ferris report, I've just done everything but stocks in the past 2, 3 issues. I'm just like, wow, I got to think of something else that's not stocks again this month because I think it's going to be a little problematic. Anyway, we have a guest today who probably has some views on all of this and has an interesting story to tell. Maybe we'll cover a little bit of that too. Very interesting guy. Some of you probably know him. He spoke at our conference this year. His name is Jared Dillian, and he has a new book out and a new one coming out. And let's just talk with him about as much of that as we can pack into an interview. Let's do it right now. The man who predicted everything from the rise of inflation to the death of the 60/40 portfolio is stepping forward with the clearest and boldest prediction of his 4-decade career. It all boils down to a single stock, and it has nothing whatsoever to do with artificial intelligence. Former Goldman Sachs trader Dr. David Eifrig believes anybody confused by the current market conditions needs to hear his story immediately. Many of America's best known investors already bought shares, including Paul Tudor Jones, New York Mets owner Steve Cohen, and Jim Simons, the man the Wall Street Journal named the world's best investor. People in the financial world know Doc Eifrig as the man who went on 3 separate winning streaks of over 100 winning trades in a row. But today, he's zeroing in on just one company and wants to hand you its name and ticker symbol at no cost. In fact, he believes every American should own this company, and soon. To get the full story free of charge, simply go to docprediction2023.com. Again, that's docprediction2023.com. Jared, welcome to the show. Glad you could be here.
Thanks. Great to be here.
So, we were just talking before we hit the record button, and I was among the few who was not able to get a copy of your book at the recent Stansberry conference. This is your new book. This is your latest one called Those Bastards.
Well, actually, no. So,
No? Okay.
Those Bastards, which is a collection of essays, came out in April, and that's the book that you all handed out at the conference. My new book, it's called No Worries: How to Live a Stress-Free Financial Life, is coming out January 23rd. And actually, I have a advanced copy of it here.
Okay.
So that's being published by Harriman House. It's coming out in January. Highly recommend everybody pre-order it. It is about how to live a stress-free financial life.
Well, we could all use that right now. It's been a stressful couple of years. A soaring market, a falling market, and pretty well soaring again if you're just looking at the big indexes. Um, but I want to talk about that because it's something that I actually try to focus on in one of the newsletters that I write. Can you give me the bullet points and then maybe we'll drill down into each one of a stress-free financial life?
Yeah, there's a couple of things. Number one, the conventional wisdom in personal finance is that you want to cut aggressively small expenses. Like the example that everybody uses is don't buy coffee from Starbucks. Make coffee at home, right? Like if you don't buy coffee at Starbucks, you'll save $4 a day, 1,200 bucks a year. You'll have 40,000 bucks, which if you invest, will be 200,000 bucks. You can have a comfortable retirement if you give up drinking coffee. Okay. And the problem with that is that coffee is a small daily luxury, and people have a difficult time giving up small luxuries, right? Coffee is hard to give up. Like coffee wakes you up, it helps you poop, like it does a lot of things. But people can give up large luxuries. So if you get a 2,400 square foot house instead of a 2,800 square foot house, you're not going to be in that house miserable. You're not going to be thinking, This house sucks. I hate it. It's too small." You'll be perfectly comfortable in that house. It'll cost $100,000 less. And over the course of paying the mortgage over 30 years, you will have saved $120,000 in interest, which is like 3 lifetimes worth of coffee. So, one thing I try to point out is it's not a million small decisions that determine whether you have money. It's a couple of big decisions. It's the house, it's the car, and it's the student loans. And if you get those three decisions right, then you don't have to worry about the little stuff. The little stuff doesn't matter. And we live in a culture that, Americans are all about the little things. Like, if I don't know if you remember that commencement speech at Texas A&M years ago with Admiral McRaven, where he said, if you just make your bed in the morning, if you just do this one thing, if you make your bed, then your day will be off to a good start and you'll be terrific. It doesn't matter. I don't make my bed. I really don't. I don't make my bed. I get up, I just leave it a mess, and then I get in it at night, and I don't care. Like, I focus on the big things. Like, we are taught that the little things matter. Little
Mhm.
things don't matter. Big things matter. Big things.
This is refreshing. I cannot tell you how many times I've had this exact precise discussion with my better half, because she's saying, "No, we can't afford the $70 bottle of wine."
Yeah, Dan, I was gonna say the same exact word, refreshing. The same thing too with
Yeah.
my better half.
It's like she says, "We can't afford a $70 bottle of wine." And I'm like, "It's $70." And then she's like, "Can we go to, like, Fiji for 3 weeks?" I'm like, "The way you wanna do it, it costs, like, $50,000." You know what I'm saying? And that's
Yeah.
not 3 weeks, actually. That would be 150,000. I mean, it's, God bless you, Jared. Thank you. If that's the main point of the book, I'm pre-ordering right this split second, and I mean it. I'm clicking pre-order right now, because that and I'm not gonna read it. I'm gonna give it for a gift to you know who.
I mean, see, here's the thing. Like, the personal finance industry has this mythological person with $100,000 Chevy Silverado and a 580 credit score, and this person that spends too much and buys $70 bottles of wine and is in debt. This is the bad person. Like, we say, this is the bad person.
Yep.
It is possible to spend too much money, but what the personal finance industry doesn't talk about is the person on the other extreme, the person who spends too little money. Americans are cheapskates. We are a nation of cheapskates. We are lousy tippers. We don't give to charity. The average charitable donation is $850. That's for a year, which is 4% of the median income. We don't give that much to charity. We're lousy tippers. We buy generic brand pork and beans at the grocery store. Like, the vast majority of people are very good with their money, but the problem is that they spend too little. And the consequences of spending too much are you're in debt, you're paying lots of interest, you could go bankrupt. But the consequences of spending too little are it damages relationships with family and friends because you're cheap. If you have a relative that is cheap, and I'm sure you know somebody that is really cheap, it is really hard to be around this person, right? Like, they're constantly chiseling, you know.
Yeah, I mean, I'm not gonna name any names here on the podcast, but, there is one particular individual that we always have to think about. Now, if we're gonna do this, we have to think about, being around Mr. X, or Mrs. X, whoever it is, and I agree with that. But the phrase "spending too little," I'm sure will rankle many ears. I mean, many listeners will say, "Spending too little? What do you mean?" Because we are also, I guess maybe I won't try to preface this, I'll just ask the question. We we often hear, "If you take care of the pennies, the dollars will take care of themselves." Is this not true to any extent, Jared?
No, it's not true. Actually, the opposite is true. Like, the goal is to have a healthy relationship with money. If you spend too much, then money is your master. You're trying to make the monthly payments. You're laying in bed at night worrying about how to pay the rent. Money is your master. If you spend too little, if you're agonizing over whether to get a soda out of the soda machine, then money is your master. Really, the problem with this book is that it's presenting a middle of the road solution. Okay. And in personal finance, people have been putting forth extreme solutions because extreme solutions are really easy to understand and implement. For example, cutting up your credit cards and just using cash and living off the grid. That's not realistic, but it's really easy to understand.
Mhm.
Or, I'm going to go into debt and buy a bunch of rental properties and do the passive income thing, like massive amounts of debt. Like it's not realistic, but it's easy to understand. The middle of the road solution is the hardest solution. It's the hardest to implement, trying to find that balance.
Ah, now we have encapsulated into a single concept, balance. That we all understand, don't we? We all know
Yep.
what balance is, and we're all we all tend to be it's sort of like that story about, one of the early Apollo missions. They said they were off course 99% of the time because they're constantly correcting. Constant. They got there because it was a constant exercise in course correction, and I feel like that's, uh admittedly, I mean, all cards on the table, that has been my financial journey, um, in life. My personal financial journey is the constant course correction. I spent nothing for years because I had spent way too much and gotten in way over my head when I was very young, and then I spent nothing. I mean, I was all cash and just I wouldn't buy a car, so balance. Alright, so y that you've definitely sold 1 copy of the book here, I just bought it, so
2, Dan. I'm gonna get one too, Dan.
alright, 2 copies, alright, let's see how we can affect this during the show. Um, balance is good. You got another one from the book that you wanna share?
Yeah, so there's only two sources of financial stress. Like a lot of people, when they think of financial stress, they think of somebody who doesn't have any money, is living paycheck to paycheck, they're struggling to pay the bills.
Mhm,
But that's not really a source of financial stress. There's only two sources. One is debt. Debt is a source of financial stress, and the other is risk, financial markets risk, right? So it's not a function of how much money you have. I know people who have no money, virtually no savings. They pay the bills every month and they're happy because they don't have debt and they don't have risk. The richest guy in the world, Elon Musk, took out a bunch of debt to buy Twitter. Tesla went down 75%. He almost got a margin call. Like the richest guy in the world almost went Tango uniform
mhm.
because he had too much leverage, right? So he has lots of financial stress. So whether you have financial stress is really how you structure your financial affairs, how you structure your life, and how much debt you use and how much risk you take on.
Jared, this is Corey. You're speaking so much to my outlook on finance and how I got into this industry. I obviously nobody is born knowing everything about money, but I was did know squat, and you're taught. Or some people are taught, like money's the root of all evil. Like that's is it's not something you should be, trying to understand. But you should be. That's exactly the opposite. You should be trying to understand uh, money and how it works and how the financial system works and just what you said there like touches on like spending less than you make, right? No matter what those levels are, right? Like Elon Musk
Yep.
or whoever is doesn't have a huge investing account and is happy, like you said. I mean, so yeah, I'm excited to get a hold of this book too.
Yeah, I'm not saying I don't still have both of those sources of risk operating in my life, but it's not the disaster it was years ago.
Let me tell you a quick story. Um, this just happened. This just happened yesterday. I booked a trip to Memphis for a Christmas party in December, like pretty close to Christmas, and booked the flights, booked the hotel, and I was going through my email yesterday and I saw the confirmation for the hotel and it said November 21st. And I said, "Oh no, I booked it for November instead of December," right? So I called up the hotel and I said, "I screwed up. I booked it for the wrong month. Can you help me out here?" And they said, "Well, our cancellation policy is that if you cancel at 10 a.m. on November 21st, you get a refund, but it's 5 p.m., so you're out of luck." So I basically set $450 on fire,
Mhm.
which it was stupid. Like it's just an absolutely stupid thing to do. I just wasted $450. And I'm sitting on the couch and I told my wife about it. And I'm like, I'm sitting here worrying about 450 bucks and my investments are moving around $100,000 a day. You know what I mean? Like, so it's really about perspective. You know
Yep.
what I mean? Like,
Jared, this reminds me of Harry Brown, How I Found Freedom in an Unfree World, and he talked about personal finance, and he said that at that time, I think the book was published in I want to say the '80s, long time ago. So the numbers reflect that, and he said, I don't care about anything that costs $100. I don't care. If somebody comes to me and says, you need to do something and it costs $100, I just give them the $100, they do it, and I don't care. So he developed that threshold, and that's what you're describing. The threshold
yep,
is,
yep.
it's for a guy like you who's 100,000, down 100,000, by the minute, by the day, whatever, maybe 450 isn't so bad, so you don't care. And for me, I've realized that I think life kind of put this on me. It's somewhere in the $500 to $700 range, just because like home ownership involves myriad expenses approximately in that gap. Getting things fixed and having things serviced and having people come and do things all the time. And I just, like, stopped worrying about how much it costs. And my wife will say, "This guy charges 400, that guy charges only 375." I'm like, "Don't care. Stop, don't wanna hear it. Don't wanna hear it. Go
Will
away.
they show
Make
up
it
at
go
my
away.
house? Yeah, will they be here on time?
Yep. Don't care. Make it go away." So, I like this. I like this book, and it's not even out yet. So, wow, I have to admit, I've had Street Freak on my shelf, your first book, for a while now, and I couldn't even find it. Like, we were gonna get you on the show. I was like, "Hey, great," and I couldn't even find the thing, and I haven't read it yet. So, like, you've just, like, put a fire under me. I'm like, I'm reading Jared Dillian next. That's what I'm doing next.
Cool.
Yeah. So let's talk about, now that we've discussed personal finance, which is a great topic that we hardly ever get to. Um, what do you see when you look out at the wide world of, our listeners are going to be mostly interested in the stock market, but boy, after the last year and a half or so, they're sure interested in interest rates as well. So what do you see when you look out at the wider world in the stock and bond markets?
Yeah, I mean, I've actually mostly been focused on the bond market probably for the last 6 months.
Yep.
The yield curve inverted 16 months ago.
Hmm.
And typically, after a yield curve inversion, you get a recession anywhere between 3 weeks and 18 months. Okay. So we're getting close to the limit here. We're getting close to 18 months. We also had the deepest yield curve inversion since the early 1980s. So it was a very deep inversion. Okay. The economic data has been deteriorating very slowly over the last year. If you look at the 12-month average of claims and payrolls, it's been coming down very slowly over the last 12 months. I think one of the main reasons we haven't gotten a recession yet is this is, every recession is different. And I think it's because of the 3 trillion of stimulus we pumped into the economy, and that money is still sloshing around, and it's taking the economy a very long time to roll over. And there's a group of people, they call themselves the higher for longer crowd, and I don't know if you guys are part of that crowd, but basically the belief is that even though the yield curve is undefeated as a recession indicator, this time is different. We've heard that before. This time is different, and we're not going to have a recession, and interest rates are going to keep going higher. Which I totally disagree with. I don't think we've eliminated the business cycle. I just think it's taking a long time to happen. I think we'll be in recession sometime in the next 6 months. Um, I think that the Fed funds curve, which is pricing in the first rate cut in May, I think that's probably about right. I think it might happen earlier, but no disagreement there. And Yeah, I mean, that's basically it. Like, I believe we're going to have a recession. I think 2 year notes are going to go to 2.5%. I think 10-year notes are going to go to 3.5%. Well, the curve will be 100 basis points steep. And it just makes a lot more sense to be in bonds rather than stocks right now. You know, you're getting a 4.5% coupon. If you look at investment grade, you're getting 6 to 7%. If you're looking at high yield, you're getting 8 to 9%. Like, it just makes more sense.
And if you can do private lending at all, you can get double digits.
Yeah, right. That's a whole other story.
Whole other story and requiring great skill, but there are people who have that skill. You know, I just looked, I just, I bought the new book, No Worries, and then I just looked, I was gonna go buy Those Bastards, and Amazon says, "You purchased this edition on April 2nd, 2023," so it's around here somewhere, you know, in the thousands of books. I'll find it. It's in there somewhere. So, I didn't need to get a free copy, I guess. But do you think it's different? Well, I don't want to say it's different this time, but do you think that coming out of COVID, you know, the basically the shutdown of the economy and then restart changes the cycle at all? Doesn't sound like you do.
I think it lengthens it. I think it lengthens a cycle, but I don't think it eliminates a cycle,
Hmm.
you know?
Or the cycle is not of a different character. It's the difference is only in length. In other words, it's not in any
Yeah, I
qualitative
mean,
way.
like, so for example, we got existing home sales the other day. It was a horror show. Like, it was terrible.
Hmm.
Like, the median price of a house is down. The time to sell a house is down. The transaction volume is down. Um, one of the interesting things about the housing market is that it stayed pretty strong even as rates went up. I mean, rates went up to tens went up to 5%, and the housing market was trucking along. And finally, it just takes time. Rates start to bite, and now the housing market is rolling over, and the housing market is really, a big engine of the economy. And if you look at the NAHB survey, it came in at 34, which is, well below 50. So yeah, I mean, things, if it we got durable goods today, which came in at down 5.4%, like, the data is rolling over. I have confidence that this is going to happen.
Jared, I'm similar view of seeing the data been rolling over for the last, now and the past couple of months too. And perhaps start in pre-recession or early recession behavior with the yield curve and all of that. But as far as the markets are still responding, that's this bad news is taken as good news for the moment, right? It seems like. Do you think that's true, or if and then when does the bad news become you know, bad news for the markets and stocks and that.
Yeah, so you actually see this phenomenon at the top of every cycle. You saw it in 2000, you saw it in 2007. So when the
Uh-oh.
economy begins to roll over and rates start to come down, the stock market responds to lower rates by going higher in the short term. But eventually the economy gets really bad. Like you said, bad news becomes bad news. I saw a really great chart about a month ago that showed the last rate hike in a rate hike cycle in the context of where it was in the stock market. And the last rate hike was at the top of the market in 2000, and it was at the top of the market in 2007. Um, so yeah, I have no illusions that the Fed is going to begin cutting rates at some point in the near future. So I mean, and stocks will respond to that, but ultimately the trend will be down. So just in the short term, I mean, looking at the market over the last couple weeks, the stocks got down to 4,100, 4,150. We're up about 10% off the lows. We're getting back to the previous highs of 4,600, the all-time highs of 4,800. Kind of feels like stocks have some momentum here. I think we're getting close to where you could put out a short, somewhere between 4,600 and 4,800 in the S&P. But I'm not in a hurry to do that because sentiment is not at extreme levels yet. We're not at extreme bullishness. In fact, we're not even really close. Like, we're not at those extreme bullish levels.
No. We are still at extreme valuations on the S&P 500 if you just take the whole index.
Yeah, I think the S&P is at like 20 times or 21 times or something like that. It's still super expensive. Yeah.
Right, especially compared to, you're talking about 4.5%, 10 years. We've been here before, over the past decade or so, but 10-year wasn't 4.5%. So
I
just
mean, the
simply
stock market is higher today than when the rate hike cycle started. Like the Fed has hiked 550 basis points, and stocks are actually higher than when it started, which is insane.
Yeah, that is.
it seems insane. But Jared, like, I'm just playing devil's advocate here because I do agree. Um, it seems insane, but then again, what is it, 5.25, 5.5 on Fed funds? Like, that's kind of back to just normal, though, right?
Yeah, that's the argument you hear a lot from people that you hear it a lot from the bond bears. Like you say, okay, well, rates on tens is at 4.5, which is basically the average over the last 100 years. So we're just up to average levels. And the logical conclusion from that is they could go a lot higher, right? Um, I don't. I think that's faulty logic. I don't think that's necessarily the case. First of all, like maybe rates go higher in the long term, which is super possible. Like that could definitely happen. But markets don't do anything in a straight line. Like it's highly unlikely that 10-year yields are going to go up 800 basis points in a straight line. Like that's just not going to happen. So if you look at path, if you look at sort of this path dependency of the rate markets, what I think happens is that rates go up to 4.5, they pull back to 3.5 or 3, and then perhaps 2 years from now they go to 6 or 7. I think that's entirely possible.
Right. And as I grab a quick chart on Bloomberg of Fed funds target rate, your comment about path is quite evident. There are cuts in hiking cycles and hikes in cutting cycles.
Yep.
So getting a cut in, just call it March, April, May, whatever it is. You said May, I think.
May, yeah.
Not necessarily like, um, that could be could that not wind up being a cut in a hiking cycle? I mean, we're guessing about the future here, but I'm just saying, um, because there is the other view that the Fed is sort of has its back against the wall, and if they hike anymore, they'll crash the economy, and if they cut anymore, they'll just reignite inflation. However many basis points it takes of cuts, and then we're back at pick your number on the CPI and PCE.
I think it was prudent for the Fed to pause rate hikes, because we basically had the fastest rate hike cycle in history. We did 500 basis points in a year. So I think it's prudent to pause and let those rate hikes work through the economy. And I think that's happening. But I lost my train of thought. Totally forgot what I was going to say.
So just for our listener, I'm looking at Jared, and he's got almost as much gray hair as I do, and that happens to me all the time on the show. Yeah, we edit it out, but it happens.
At least you guys have hair.
Anyway, it was, I don't know, it was not a great question anyway, because we're just sort of guessing about the path of rates,
Rate
which
cuts
is,
within a
we don't
hiking
know.
cycle, which when the
Yeah.
when the Fed cuts rates, or if they cut
Well,
rates, yeah.
I mean, it's really dependent on inflation. And one thing I'm very fond of saying is that inflation is not an economic phenomenon. It has nothing to do with economics. It's all about psychology. It's all about psychology. And during the pandemic, when we were injecting stimulus into the economy, we flipped from a deflationary psychology to an inflationary psychology, right?
Mhm.
So if people believe that there is going to be inflation, then they will act in such a way that causes inflation. Let me give you an example. You're going to go buy a bag of fertilizer at Lowe's and it costs $8, right? But now you have inflation and it costs $10. So you say, well, instead of getting one bag of fertilizer, maybe I'll get 10 bags and just keep them in my basement at home. So the act of you buying 10 bags and everybody else buying 10 bags causes the price of fertilizer to go up. So if people believe that prices will go up, they actually cause prices to go up. I don't think that we've broken the inflationary psychology. People still have an inflationary psychology. People believe that prices are going to go higher, especially with food. Like that's the big thing. People believe that food prices are going to go higher. So it accelerates consumption and it perpetuates this inflation. The reason that we got out of the inflation of the 1970s is because Volcker's rate hikes caused a severe enough recession, which, by the way, was minus 6% of GDP, minus 6% GDP, a severe enough recession that it broke that psychology, so people stopped expecting price hikes.
That's for
So
sure.
even though we've hiked rates 5%, I don't think it's enough to break that psychology. And I do believe that if we do start cutting rates, it will reignite inflation, and we're going to have to go through this whole nightmare all over again. So, I look at things as a trader.
Mhm.
I believe that I believe that we'll have a recession. I believe that the Fed will cut, but ultimately that will lead to more inflation in the future and higher interest rates. So
Purely inflation is a purely psychological phenomenon, Jared? Not there's no place
I
for
think
the fact
so.
that we printed up trillions of dollars, issued trillions in debt and spent trillions, and, the fiscal picture kinda went off the charts as though we were in World War
Well, I'm
III.
all right. So I might be exaggerating things a little bit because,
Okay.
as Milton Friedman says, it's a monetary
Monetary
phenomenon,
phenomenon. I
right?
was gonna do
And
the
it's
same
purely
quote. Yeah.
yeah, it's purely a function of more money chasing the same amount of goods, right? So that
Mhm.
too. But I look at you know in my newsletter, like I focus almost exclusively on sentiment. I focus on psychology. So that's kind of my bailiwick. That's what I do.
I
So
see.
that's the framework from which I look at it.
Gotcha. Alright. So that's a pretty balanced view, actually, because, you could see easily, perhaps long after the, increase in money and credit has worked its way through, that the psychology would still be there. I could
Yeah.
see that all day long. So so it does make a little bit of sense, and it makes me wonder. Actually, you know what? Forget what I was just about. I was gonna talk about inflation some more, but I gotta talk with you about a personal pet peeve of mine in that very same vein. Oh, it's more than a pet peeve. I just, I tend to believe that the last, call it, well, just go back to 2009. Since then, investors have this viewpoint that it's almost like US stocks are the safest, greatest thing in the world. They can always be bought no matter how expensive they are, and they'll never go sideways. We'll never see that again, even though we've seen it multiple times in the past century. And there is no alternative still. I think this moment in particular is a dangerous time for that, and I think it's going to take a horrendous beating, which the market tends to deliver them when people require a horrendous beating. It tends to deliver them. Not on any schedule that I know, but it seems inevitable. Um,
We are about 22 months below, almost 23 months below the high water mark. So the top of the S&P was January 3rd, 2022.
mhm,
So we're coming up on 2 years without making a new high, right?
mhm,
And we have had some periods in time, very long periods of time, where the market didn't make a new high. So from
yes.
1929 to 1945,
Mhm. The
from 1969 to 1982, we have had periods of a decade or more where you did
mhm,
not get a new high in the stock market. And that is, it's funny because we're not that far away from a new high, and valuations are high, but that is brutal on sentiment. And a lot of people do anchoring. I'm sure you know what anchoring is, where
sure.
people look at the high watermark and they say, "Well, if I can just get out where at the highs, if the market just gets back up to the highs, I'm going to sell and I'll break even and whatever." So there's a
Classic,
lot of
yes.
anchoring going on,
Yeah. Yeah, right. That is classic investor foible. "Oh, boy, I didn't see that coming, but I'm just gonna wait till I get back, and then I'll get out," and you never
Yeah.
get back. That is, bull market thinking, right?
So, I mean, we could easily have a 10-year period where stocks basically go sideways, to your point. And, over that 10-year period, earnings come up and valuations compress. And then maybe in 2033, we have that 1982 moment where you have single digit PEs and 6% dividend yields, and stocks are really cheap. And that is the seeds for a new bull market.
Mhm.
But we could totally go sideways for 10 years.
Yeah, I agree. I think the likelihood I won't make any prediction, but I think the likelihood of that is higher now than it has been. Um, so what do we do about all this? Are you, you know, you said you just you like bonds. Are you just avoiding stocks until you get a recession?
Pretty much the only stocks I own are non-US stocks. I don't own any US stocks at the moment. Um,
Wow.
it, yeah, I own stocks in Argentina,
Nice.
which yeah, which the funny thing about that is that I have done a lot of work on Argentina over the years, going back to like 2013, 2014, and I'm pretty plugged into the politics there. And when Malay sort of began to rise about 8 months ago, I took notice of it, and stocks in Argentina were starting to lift a little bit, so I bought a couple of stocks, added to the positions, and yeah, I mean the election was great. But if Argentina dollarizes, which I think they will, I think they'll be able to accomplish that. There's precedent for this. When Ecuador dollarized a few years ago, they had like 8-9% GDP growth for a decade, you know. So Argentina could really, really grow. Like the whole market, there will be some pain. Dollarization will cause some pain, but I think over the next 5 to 10 years, you could see 3 to 5x in returns in Argentina. I think India is a big opportunity. India is a huge opportunity, especially when you look at it in terms of flows.
Mhm.
Where China is basically uninvestable and Russia doesn't even exist anymore and Brazil's a mess. I mean, if you're an emerging market investor, like India is really the only economy that is showing any sort of growth that has stable politics. Like all the EM flows are going to India, and India's had a pretty good bull market over the last couple of years. So I don't have any interest in buying like stupidly expensive US stocks where things are not super stable around here. Like there's other places in the world to go where there's a lot more growth that are a lot more promising.
If you would you buy Argentina right now? Sounds like you would.
I would actually. I would.
So, and I think I just looked at a screen briefly the day Milei got elected in Argentina, and I think the Argentina ETF was up like 35% or something just in one day, just soared.
Yeah,
So,
just like word to the wise about that Argentina ETF. It's not a very good ETF.
mm,
There's one stock that's 45% of the ETF. It's Mercado Libre. It's basically the Amazon of Argentina, and it's a tech stock, and it's um, if you're buying ARGT, it's really you're buying one stock. It's like half the portfolio, so it's not a good basket.
plus it's tiny too.
Yeah, Argentina has 19 ADRs. There's banks and oil companies and mining companies that you can pick from just buying the ADRs. So
Any similar,
Yeah.
words of warning on India, ETFs or investments? Because, like you said, there a lot of times people will run out and buy these ETFs but not know what's in them.
well, the only thing I'll say about India is that you want to go large cap. India has had a little bit of like a minor bubble in small cap stocks. Small cap is run up a lot in India, and it's kind of junky and it's a little overpriced. You want to stick with the big large cap market cap weighted ETFs.
All right. Yeah, I've had the same advice from Rahul Saryogi, who we haven't had on the show in quite a while. Is He's a native Indian. He's operates out of Chennai, and he's told many people. I've been in his presence. He's told me and many others. And he'll say, "Just buy the ETF. You'll be fine." Meanwhile, he's like picking stocks. He should be going after clients. But it's time for our final question already. This has just breezed by. This has been a lot of fun, and
Yeah.
it's the same final question for every guest, no matter what the topic, even if it's a non-financial topic. Same question, same final question. And the question is very simple, Jared. It's if you could leave our listener with a single thought today, what would it be? And if you've said it already, we don't mind you repeating it.
I mean, aside from the book, which is the obvious one, I'd love to say buy my book, but aside from that,
Okay.
um,
Two
I would
thoughts.
say that sentiment is. Let me phrase it this way: fundamental analysis is no good because the market is efficient. You're looking at publicly available information. Everybody's looking at the same information. Everybody's done the same ratios and calculations a million times. It's no good. Technical analysis, I think, is slightly more effective. But at the same time, everybody's looking at the same charts, drawing the same trend lines. There's a little confirmation bias. It's not as effective. The one thing that works in markets all the time is sentiment analysis, is analyzing sentiment. It's just axiomatic. Like when everybody is bullish on something, it's time to get bearish. When everybody's bearish on something, it's time to get bullish. Um, there's been some attempts to systematize this. Some hedge funds have done this. I don't systematize it. I like to tell people that I'm not the quantitative analyst. I'm the qualitative analyst, right? I listen to stories and anecdotes and talk to people and look at Twitter and stuff like that. I look how people are feeling, and that's how I get my edge in the markets. And
Uh,
it's repeatable. It's a very repeatable process. So sentiment is how you succeed in the markets. That's my thought.
Thank you for that because you are only the second guest in the 5 years I've been doing this to say that. Do you wanna take a guess who the other one was? You might know him.
Cormac Kinney.
No, but we'll be having him on the show soon if we can get him. Chris Camillo. Chris Camillo was one of the, he was covered in one of Jack Schwager's books, and he's like the social media trader, basically. He looks at the, sort of sources you do for sentiment in industries and stocks and everything, and he says he does the third way, right? He doesn't do fundamentals, he
Yep.
doesn't do technicals. It's the third way, exactly as you described. So,
Yep.
of course, I'll get into it after the whole world is into it. Um, I'll get into it right at the end when it becomes worthless. But Jared, great talking with you. I really enjoyed this. I love what I do, but this one is more fun than average.
Thank you. Thank you.
Yeah.
And I appreciate you letting me come on and plug the book. And
Oh, sure.
that's super helpful. And I hope the book is a big success. And if it is, it'll be partly because of you guys. So thanks.
Hey, great. Glad to help. And yeah, I'm happy for you to talk about your book. We want to know everything we can about you, so that's cool. But yeah, thanks for being here. We'll definitely be inviting you back too.
Great. Thank you.
NVIDIA may be America's top performing stock after more than doubling this year alone. But if you're holding NVIDIA or thinking of buying it to get a stake in the $7 trillion AI market, you're going to want to see Mark Chaikin's new AI prediction first. Mark is a regular on many major news outlets from Fox Business to CNBC, and he built the stock indicator Wall Street uses to find winning stocks. His award winning system flashed buy on Tesla before it climbed 335%, Moderna before it climbed 300%, and Riot Blockchain before it climbed 10,090%. It also found NVIDIA at the start of 2023 before its massive bull run. But right now, Mark is stepping forward to warn people to stay away from NVIDIA. My system has indicated that NVIDIA is no longer the best stock to buy to profit from AI, Mark says. In fact, it just flashed buy on a totally different AI stock. And today, he'd like to hand you the name and ticker symbol of his number one AI stock to buy right now. For a limited time, you can get this information for free at www.aifreenzyreport.com. Again, that's www.aifreenzyreport.com for a free copy of his new report. Well, I hope our other guests don't hear this because I just wanted to say again, that was more fun than average. I really enjoyed that a lot. I think you
Yeah,
did
I
too.
mean, I love talking personal finance because I feel like that's the start of getting into investing. Like we said there, spend less than you
Mhm.
make, and my thought has always been that, and smartly invest the rest. So try to do that as much as possible. So his message really stuck with me, and honestly, his outlook on the markets pretty much aligns with what I've been thinking myself. I've written that bad news has been taken as good news so far, and eventually, I think the bad news will turn into bad news with a recession at some point next year. Who knows what it looks like? But yeah, so yeah, I enjoyed that a lot.
Yeah. I'm less convinced on the recession argument than others, but I don't want to get into it here. I want to talk about Jared, who, by the way, we didn't talk anything, and just, for the listeners' benefit here, folks, you should really take Jared seriously. Like, he was at Lehman Brothers, and he wrote a book about it, his first book called Street Freak, and he had quite the experience there.
Right. Lost his job in '08.
Yeah. So, he saw some stuff, and he's been through the ringer and been around the block. So that's where he gets this insight, and the fact that, a guy like that is saying, "I don't do fundamentals or technicals. I do, I don't even know what to call it, sentiment," I guess he called it. Um, Chris Camillo had a different term for it. I can't remember it, but I should probably know it. I should probably know this inside and out, and get ahead of the curve, because um, more smart people who are making tons of money that I hear talking about this, the better I like it. So, do you allow sentiment to influence your investment decisions, like, at all?
Yes. Yeah. If particularly if it helps align with other factors, like say like last year we saw the bearish uh, uh, crowd was out like early and often, and people thought, oh well, then things must be turning around. But there are other factors to look at that would lead you to believe the market could keep going lower through last year. But like a couple weeks ago, when things were oversold and people were really bearish, that was a moment where I thought, it put a little more emphasis on sentiment there. So yeah, I mean, like he said, Jared said he writes about that he has a newsletter too, the Daily Dirt Nap, which is a great name. And so if you're interested in more from him, you can check that out too. It's a very popular newsletter already. So
Yeah, we did have quite I don't know, a spike in negative sentiment. I don't know what to call it. A spike in negative sentiment on the 10-year, right back on October 19th, which is, I think that's the date that Porter Stansberry was talking about when he was on the show last time, as being kind of an inflection point, and prices came off of that, and he's like, "Well, okay, we're not going to get a crisis," and and I have to say, it's been a little dramatic. The 10-year was just call it 5%, right at about 5%, and now as we speak, 4.4%, which is quite a
yeah,
move
it's been quick.
in about a month. So wow, yeah, maybe there's something to this thing. All right. Well, that's another interview, and that's another episode of the Stansberry Investor Hour. I hope you enjoyed it as much as we did. We do provide a transcript for every episode. Just go to www.investorhour.com, click on the episode you want, scroll all the way down, click on the word transcript, and enjoy. If you like this episode and know anybody else who might like it, tell them to check it out on their podcast app or at investorhour.com, please. And also, do me a favor, subscribe to the show on iTunes, Google Play, or wherever you listen to podcasts. And while you're there, help us grow with a rate and a review. Follow us on Facebook and Instagram. Our handle is @InvestorHour. On Twitter, our handle is @investor_hour. Have a guest you want us to interview? Drop us a note at feedback@investorhour.com or call our listener feedback line, 800-381-2357. Tell us what's on your mind and hear your voice on the show. For my co-host, Corey McLaughlin, until next week, I'm Dan Ferris. Thanks for listening.
Thank you for listening to this episode of the Stansberry Investor Hour. To access today's notes and receive notice of upcoming episodes, go to investorhour.com and enter your email. Have a question for Dan? Send him an email, feedback@investorhour.com. This broadcast is for entertainment purposes only and should not be considered personalized investment advice. Trading stocks and all other financial instruments involves risk. You should not make any investment decision based solely on what you hear. Stansberry Investor Hour is produced by Stansberry Research and is copyrighted by the Stansberry Radio Network.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates. You should not treat any opinion expressed on this program as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of opinion. Neither Stansberry Research nor its parent company or affiliates warrant the completeness or accuracy of the information expressed on this program, and it should not be relied upon as such. Stansberry Research, its affiliates, and subsidiaries are not under any obligation to update or correct any information provided on the program. The statements and opinions expressed on this program are subject to change without notice. No part of the contributor's compensation from Stansberry Research is related to the specific opinions they express. Past performance is not indicative of future results. Stansberry Research does not guarantee any specific outcome or profit. You should be aware of the real risk of loss in following any strategy or investment discussed on this program. Strategies or investments discussed may fluctuate in price or value. Investors may get back less than invested. Investments or strategies mentioned on this program may not be suitable for you. This material does not take into account your particular investment objectives, financial situation, or needs, and is not intended as a recommendation that is appropriate for you. You must make an independent decision regarding investments or strategies mentioned on this program. Before acting on information on the program, you should consider whether it is suitable for your particular circumstances and strongly consider seeking advice from your own financial or investment advisor.